Alright, if you care about metals, macro, or just protecting your money, stop scrolling for a second and stay with me. In the last 24 hours, silver didn't just dip. It fell off a cliff. We're talking about a negative 21.5% move from roughly $120 an ounce down to about $97 in a single day. That's over $1.4 trillion in value, gone, basically overnight. And here's the key thing you need to hear right now. This wasn't caused by a sudden collapse in physical demand. That's not what did this. The real trigger is something far more mechanical and far more important for what comes next. Both futures market data and physical premium tracking out of Asia just confirmed this move was driven by forced selling, not choice. Stay with me, because I'm going to show you how to recognize this pattern before it happens next time, and how to think clearly when everyone else is panicking. If you're watching this now, you're ahead of 99% of people trying to make sense of this chaos. Before I explain what caused this, let me teach you something most people don't really understand about markets. Prices don't move only because fundamentals change. They move because positioning changes. Think of a market like a crowded elevator. As long as everyone's calm, it's fine. But if the cable snaps even a little, it's not about who believes in the building anymore. It's about who gets shoved out first. Leverage is that crowding. When prices go parabolic, leverage builds invisibly. You don't see it on the chart, but it's there, stacking higher and higher. And when something breaks, the market doesn't politely reprice. It forces people out. That's what you're seeing here. This is about leverage unwinding, not silver suddenly becoming 20% less valuable in real life. Ask yourself this. Did industrial demand fall 20% yesterday? Did global mine supply jump overnight? Of course not. The metal didn't change. The positioning changed. And that's the distinction that separates people who panic from people who see opportunity. If this is making sense so far, drop a comment and let me know where you're watching from. I want to know if you're holding, watching, or completely sitting this one out. Now here's what's actually happening, step by step. Silver had been in a parabolic rally, and parabolic moves attract leverage like a magnet. Traders pile into futures, options get stretched, margin requirements quietly become the real risk. Nobody talks about margin when the price is going up. Everyone's celebrating, but that's when the trap gets set. The primary driver here was margin pressure. As silver pushed higher, leveraged longs were sitting on massive paper gains. Then volatility spiked. When volatility spikes, exchanges raise margin requirements or brokers tighten risk. That's the trigger. It's not dramatic. It's bureaucratic. But it's deadly. Once price started slipping, margin calls hit. And when margin calls hit, selling is not optional. It's automatic. You don't get to say no. You don't get to wait it out. So contracts get liquidated, price drops faster, which triggers more margin calls, which forces more selling. That's the cascade. It's mechanical. It feeds on itself. And it doesn't stop until it runs out of fuel. The secondary confirmation is volume. This move came with explosive futures volume, not a slow bleed. That's liquidation. That's not people waking up and deciding silver's not worth it anymore. That's algorithms and clearinghouses forcing exits. You can see it in the tape. You can feel it in the speed. When you see volume surge like that on a down move, especially after a parabolic rally, you're watching forced selling. Period. And here's the convergence proof, the thing that ties it all together. While paper silver was collapsing, physical premiums didn't collapse with it. In some regions, especially parts of Asia, they stayed elevated. That divergence matters. It tells you the physical market didn't agree with the paper market's panic. The people who actually take delivery, who actually want the metal, they didn't suddenly stop wanting it. They're still there. The price drop was a paper event, not a physical supply event. But here's the part that should make you nervous if you're not paying attention. This kind of selling doesn't end when people feel better. It ends when the leverage is gone, when there's no more forced sellers left, when the margin calls are done. That's when you find the bottom. Not when sentiment improves, not when the news gets better, when the mechanics exhaust themselves. And we're not there yet. We might be close, but we're not there yet. So if you're thinking about jumping in right now, ask yourself, do you know how much leverage is still in the system? Do you know how close we are to the end of the cascade? Because if you don't, you're guessing. And guessing in a liquidation event is how you become the liquidation event. This is the exact same playbook we've seen before. Go back to 2008. Forced liquidation crushed everything, including assets with strong fundamentals, and the bottom came when sellers were exhausted, not when the news got better. Oil went from $147 to $33. Gold dropped 30%. Everything got hit. It wasn't about fundamentals. It was about who had to sell and who was left standing. Look at 2011 in silver. The crash wasn't the end of the bull market narrative. It was the end of excessive leverage. Silver went from nearly $50 down to $26 in a matter of days. Same pattern. Parabolic move, leverage buildup, trigger event, cascade. Or March 2020, same thing. Violent selling, mechanical selling, followed by stabilization and then repricing once price discovery took over. Gold dropped nearly $300 in 2 weeks before bouncing back harder. When you zoom out, you see the pattern clearly. Sharp, fast declines tied to leverage tend to happen near inflection points, not at slow, orderly long-term tops. That doesn't guarantee what comes next, but it tells you what this was. This was structural. This was technical. This was predictable if you knew what to look for. Now let me be skeptical for a moment, because you should be too. Could this keep going lower? Absolutely. Markets can overshoot in both directions. Just because the fundamentals didn't change doesn't mean price can't go lower in the short term. Could there be manipulation? Maybe. Could central banks be involved? Could big players be pushing this down deliberately? Look, I'm going to be honest with you. Blaming manipulation doesn't help you make decisions. It might make you feel better, but it doesn't protect your capital. What matters is what you can actually observe and manage. Price, volume, volatility, and spreads. Focus on what you can control, not what makes you angry. Emotional narratives don't protect capital. Risk management does. If you're sitting there fuming about who's behind this, you're missing the point. The mechanics are what matter. The fundamentals are what matter. Everything else is noise. There are probably 3 types of people watching this right now. First, there's you if you were over-leveraged or chasing the move. If you bought silver on margin at $115 thinking it was going to $150 and you just got liquidated, if that's you, this was already decided. The market made the decision for you. And I'm not saying that to be harsh. I'm saying it because the lesson here isn't shame, it's structure. You need systems that prevent you from being the forced seller. You need position sizing that lets you survive volatility. You need to understand that parabolic moves end badly for people who chase them with leverage. Learn that now. Burn it into your brain. Second, there's you, if you're long-term bullish on silver and already holding. Maybe you've been stacking physical for years. Maybe you own miners or ETFs with no leverage. Your question isn't, should I panic? It's, has my time horizon changed? If your thesis was structural supply deficits, monetary debasement, industrial demand from solar and EVs, none of that changed in 24 hours. The fundamentals you bought into are still there. So ask yourself, did I buy this for a trade or for a position? If it's a position, this is noise. Painful noise, but noise. If you can't handle 20% swings, you shouldn't be in commodities. Period. Your job is to reassess your thesis, not your emotions. Third, there's you if you're sitting in cash, watching this like a hawk. Maybe you sold weeks ago. Maybe you never got in. Your job is patience, not hero buying, not guessing the bottom, but waiting for confirmation. Stabilization, volatility compression, price discovery. You want to see silver hold a range. You want to see volume normalize. You want to see the fear come out of the market before you step in. Different paths, same rule. Don't let emotion make the call. And here's what I want you to answer in the comments. Which one are you? Are you holding through this? Did you get stopped out? Or are you waiting on the sidelines? I want to hear your perspective because that's how we all learn. Here's where I stand. I'm not panicking, and I'm not rushing in either. I'm watching 3 things very closely. First, I'm watching whether silver stabilizes in the $95 to $100 range and starts to hold it. If it can base here, if it can build support after this flush, that would tell me the forced selling is done. That would tell me we're moving from liquidation to price discovery. Second, I'm watching whether volatility compresses after this shock or stays wild. If we see another leg down with the same kind of explosive volume, that means there's more leverage to clear. But if volatility starts to fade, if the moves get smaller, that's your signal that the storm is passing. Third, I'm monitoring physical premiums, especially in Asia. If those premiums stay elevated or even rise while paper prices are falling, that divergence is your tell. That's the physical market saying the paper market is wrong. Based on my analysis, this move was structural and mechanical, not emotional. The fundamentals didn't change by 20% in a day. Industrial demand is still growing. Mine supply is still constrained. Central banks are still printing. Electric vehicle production is still ramping. Solar installations are still expanding. None of that disappeared. What disappeared was excess leverage. And if history rhymes, if this follows the same pattern we saw in 2008, 2011, and 2020, this was the leverage unwind. And what comes next is real price discovery. That doesn't mean it goes straight back up. It means the next move will be based on actual supply and demand, not forced liquidation. I'm not a financial advisor. This is not financial advice. Do your own research. But I will tell you this, the people who make money in markets aren't the ones who panic when everyone else panics. They're the ones who understand the mechanics, who separate signal from noise, who know the difference between a fundamental break and a technical flush. If you made it this far, you're that person. You're someone who wants to understand, not just react. That mentality will serve you well in times like this. If this breakdown helped you see the situation more clearly, share this with someone who needs to hear it. Subscribe if you want more analysis like this, and stay sharp out there, because the next move is coming, and you want to be ready when it does.